Thanks for tuning in to this week's investment audiocast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we're going to start this week with our chart of the week, and we'll spend a little bit of time on this to try to explain what's going on here. But we call this the case for a bucketed portfolio. And what we did was try to compare a traditional 60% stock, 40% bond allocation, which has kind of become the gold star of a balanced portfolio approach. And we try to compare that to, well, what if you ignore percentages and you just have a bond allocation for your next 5 years of cash flow needs? And then you allow the rest of it to be invested in stocks. And we wanted to show what the implication could be on a stylized version with hypothetical performance here going forward over 40 years. And what you can see here is that kind of gold line is a 60-40 traditional portfolio that gets rebalanced quarterly. If you start with a $2 million portfolio and you have annual withdrawals of $100,000 adjusted annually for 3% inflation, you would still, if the market did what it did from a historical perspective, where stocks gained 10.3% per year and bonds were up 4.8% per year, you would still end up with meaningfully more assets at the end of 40 years, assuming no sequence of return deviations here. So just kind of a straight line performance. But if you take that bucketed approach and you say, I just want to put the $500,000 inflation adjusted that I need for spending over the next 5 years in bonds, and I want to let the rest of it run in equity, you can see the sizable difference that could make in a portfolio if returns continue to do what they've done all the way back to 1925, which of course doesn't have to be the case. But this just shows that taking a bucketed approach like that can work out well, because what it does is it allows more capital to be invested in growth assets for a longer period of time. And that has worked out to be a better result through time. So again, history doesn't exactly repeat. This is not reflective of a guarantee or anything like that for the next 40 years, but it does show the power in potentially bucketing your assets rather than just focusing on a 60-40 balanced portfolio. All right, great. With that, let's move over to market returns for the year. And we can see that the markets have continued to be quite strong with international market leadership. You've had emerging markets now returning almost 34%, developed international markets returning over 27%, large cap stocks in the US returning a very healthy 17.5%, and even small caps, which have lagged this year, are still up a very respectable 12.4%. You can see that this is in large part because, and we're going to talk about this in a little bit, that financial conditions are pretty easy out there. And you can see that in that bonds have gained 6.8% this year, which means that interest rates have fallen. And the dollar is down over 8% this year. And historically, a softer dollar has been a tailwind for economic conditions. So these things have interplayed to help stocks and commodities to perform well this year. Now, diving into some of the data supporting some of this, the first thing we'd say is that the economy has been quite resilient despite this government shutdown, which is going on and likely to be the longest shutdown, especially full government shutdown in history. There's a lot of uncertainty around that, but the economy has been very resilient. So here we're showing in the top clip in blue, this is the Dallas Fed's weekly economic index, and it does a great job tracking where gross domestic product, or real GDP, is going to be on the quarter. And you can see that their weekly economic index, which takes real-time data and that private market data to fill in the gaps for the closed things at the BLS and things like that. And you can see that this is tracking along the line of 2 to 2.5% real GDP, which is pretty solid. That's actually around the potential GDP for the economy. So despite the uncertainty over the government shutdown, the economy has been resilient and is in a range of growth that you could expect to be very normal growth if the government wasn't shut down right now. And part of the things that's been supportive, again, and supportive of the easier financial conditions is the Fed. So the Fed just cut rates for the fifth time in this cycle. They've done a total of 150 basis points of rate cuts now. And you can see that here. So we're still quite a bit higher than we were in the COVID era, but rates have been coming down, and that's been supportive for these assets and the economic trajectory. And you can also see that when we look at something like the National Financials Condition Index, which is here in orange on the bottom clip. And this index measures the financial conditions in money markets, debt, and equity markets. And then it also looks at traditional banking and shadow banking like private lending. And this index is showing that financial conditions are pretty loose. They're not the loosest they've ever been, but certainly supportive of continued economic growth. Historically, when financial conditions have been around this level, the economy has grown at about a 2.9% rate of change. So again, we see economic growth in that 2 to 2.5% range, supported by easier financial conditions. And the other support that the market has right now are the corporate fundamentals. So just looking purely, there's been about 70% of companies in the S&P 500 have reported, and looking purely at the surprises on the sales side and the earnings side, you can see the gray bar here. First and foremost, all sectors have surprised to the upside from a sales perspective and an earnings perspective this quarter. But you can see that sales have surprised over 2% for the index, for the S&P 500. And earnings have surprised a little over 7% for the S&P 500. Those are pretty strong numbers, but what's more impressive is the percentage of companies that are beating. With the most recent data, it's about 85% of companies are beating estimates right now, which is quite robust. So this resilient economy is playing into resilience in fundamentals, and that is helping to support the bull market. Now, there have been some high-profile layoff announcements, think Intel or Amazon recently, and in some of those, they have cited AI, which could be spooking employees a little bit. But when we look at the economy-wide layoff announcements, and again, the high-profile companies are going to catch your attention, but when we look at the total economy, it doesn't look like layoffs are exceedingly high right now. And as a matter of fact, the red line in the bottom is showing the monthly total, the change in the monthly total, but that black line shows the average change in it. And you can see that last month, layoffs actually, or for the month of September, layoffs actually dipped from the month prior. And though layoffs are up on a year-over-year basis, it doesn't look like any sort of recessionary amount of layoff announcements here in the economy. Now, I would caveat that with it is getting more challenging to find a job. So when you have gotten laid off, it's been a real challenge out there. And this is something that could become problematic if the economy doesn't really start to heat up here next year, which we think there's good reasons for it to do so. But you can see here these measures of structural challenges in the labor force. Job losers not on temporary layoff. That's the blue lines in the top. You can see how that's been trending higher. Folks unemployed for 27 weeks or more, so very long-term unemployment, that's been on the way up. And folks working part-time for economic reasons has been trending higher, and you see that in the red line below. So the amount of layoffs themselves are not that problematic, but when you're getting laid off, it's getting very difficult to assimilate back into the workforce, and that could potentially be more of an issue. Nothing to worry about today or to get too concerned with today, but that's something that we're monitoring. Now, when we look at international, I mentioned that developed international and emerging international markets have been quite strong. And I did want to show that Europe is also being supported by some of the same trends that are supporting the US markets right now. European GDP, the first estimate, just came in at 0.2% for the quarter. That's not very strong, but it was expected to be flat. And a number of countries like Germany, who printed a flat GDP number, were expected to show contraction. So Europe is also exceeding expectations from an economic perspective, and you can see that in the fundamentals. So the orange line in the top clip is the last 12 months of earnings, and you can see it's been on an uptrend. And then the blue line is the forecasted next 12 months of earnings, which is also breaking out to a new all-time high. So much like the US, the resilience in the economic environment in Europe and the Eurozone is also showing up in fundamentals and supporting their stock prices as well. So here's our closing thoughts for this week. The chart of the week focuses on that bucketed approach to financial design, splitting up your assets truly into grow, protect, give, and live assets, and how that could be advantageous, not just from a psychological perspective, but an actual outcome perspective, if you're able to give your growth assets more room to grow long term and still meet your spending goals. So that's one of the reasons why we support a bucketed approach to financial design. Now, most assets continue to power ahead here in 2025, and there's important supports here from Fed rate cuts. We didn't really get into the end of QT, but the Fed is ending their quantitative tightening program on December 1st. You can kind of look at that as another rate cut in itself. And just broadly easy financial conditions are supporting the asset markets right now. Now, the market has also been supported by robust earnings surprises, and that's also true in Europe, where European earnings have also been on an upward trajectory as economic conditions there have exceeded expectations. Now, there have been some high-profile layoffs: Intel, Amazon, UPS, Salesforce. Those companies come to mind. But the layoffs have not been that widespread as of yet as to really concern us over the economic backdrop. Now, what we are keeping an eye on is the increasingly difficult job market out there in finding a new job. So if layoffs do start to pick up and those challenges of finding a new job persist, then that could be an issue from an economic perspective. We're just not there yet. So we should really continue to give this bull market the benefit of the doubt for now. When you look across, you look at the improvement in the fundamentals, you look at the easy financial conditions. These are things that are supporting the market. So that's what we have for you this week. And as always, I want to thank you for joining us and wish you a great week ahead.